Welcome back to Taxes Made Simple. My name is Carlton Dennis, and today we'll be going over top 5 strategies for S corporations. Part of the reason why I'm creating a top 5 video for S corporations is because a lot of my clients have already switched out of the LLC to the S corporation. And if you're someone who's a business owner or you're thinking about going into a business, the questions are going to come up of whether or not you need an LLC or an S-Corp. And if you do eventually become an S corporation owner, you're going to want to know a little bit more about what you can maximize on your tax returns outside of just taking payroll. So my name is Carlton Dennis. In this video today, we're going to go over 5 tax strategies that you can leverage with an S corporation. But if you haven't already, make sure you click back on my video on top 5 strategies for LLCs so you're at least prepared for this video. Let's jump right in. Now, before I can tell you about the 5 strategies that I need to give you today, I first need you to understand why a lot of individuals switch from the LLC bucket to the S corporation lifestyle. You see, a lot of clients end up switching to the S corporation because they find out that the LLC ends up costing them more money. But I want you to know something, that depending on what type of business owner you are, will determine whether or not you're going to stay as an LLC or eventually transition to the S corporation. Let's dive more in. The reason why a lot of my clients operate as LLCs is because their business is just getting started. Typically, when your business is just getting started, you're gonna start an LLC so you can go set up your bank account. Not to mention, when you have an LLC, you separated the liability from yourself and your business. Now, one thing you have to understand though, is that when you're in the LLC, you're paying quite a bit of tax. You have federal taxes that go to the I, the R, and the S that you're already familiar with. You have state taxes if you're in a state that taxes. And when you're an LLC owner, you pay into self-employment tax, which is 15.3% on all net income. But what makes up self-employment tax is Social Security and Medicare. So you're paying into this Social Security and Medicare at 15.3%. It kind of gets a little heavy, right?
You're right.
And so this is when we have to look at, well, when does the benefits outweigh the cost to switch from the LLC to the S corporation? Now, most clients that I'm working with typically switch from an LLC to an S corporation when the benefits outweigh the cost, and that's usually around $45,000 net income, but it's really based on whichever state you're in. And part of the reason why I'm saying that is because when you think about the fees that are associated with being an LLC versus being in an S corp, it really comes down to paying the franchise tax to have your LLC operating every single year, the tax returns for an LLC versus an S corporation. Plus, do you have business filing requirements such as taking payroll in an S-Corp that you wouldn't have to do in an LLC? When you factor in these differences, you're looking at about a $2,000 price difference. And so if I have a business owner that's just getting started in business, that hasn't even done $20,000 or $25,000, it's hard justifying them paying $2,000 extra to transition to an S corporation, just to eliminate some of that self-employment tax.
Yeah, I feel that.
So before we dive into these 5 strategies, that is the most important thing that we have to understand, is the difference between the LLC and the S corporation for tax savings. Now let's talk about the income you could be earning inside of your LLC. If you happen to have an investment property, that is passive income. With passive income, you're not paying into Social Security or Medicare tax. So when you're thinking about whether or not you need an LLC or an S-Corp for your rental investment business, if you're earning passive income, you're never gonna have to worry about the 15.3% that most LLC and sole proprietor individuals have to pay into on net income. All right, so we've spent a lot of time covering the differences between LLC and S corporations, and part of the reason why I'm just taking it very slow with you guys is because I get that question so often. Carlton, do I need an LLC? Do I need a multi-member LLC? Do I need an S corporation? I just wanted you to understand that difference. Now that we are going into these 5 tax strategies for S corporations, you guys will have a better understanding if you should have one. Let's go in. Strategy number 1, the QBI deduction. If you didn't know, an S corporation is a flow-through entity. What a flow-through entity means is at the end of the day, the S corporation doesn't hold any income. All of the income is gonna flow over to the shareholder of the business. So if I happen to be the owner of my own S corporation, any income my S corp has made is eventually gonna flow over to my personal tax returns where I'm taxed only one time. But I have to realize something as an S corporation owner. One of the benefits of being an S corporation owner is I get to take payroll. This is how I get to eliminate part of that 15.3% that the LLC owners and the sole proprietor owners have to pay into. So I have to make sure that I'm taking payroll as an S corporation owner. But whatever I choose not to pay myself in the S corporation is subject to a 20% qualified business income deduction. This is brand new. It was implemented in 2018 as a part of the Tax Cuts Jobs Act. And what it means is that if you have an S corporation, whatever you choose to not pay yourself in payroll, which means the business income, you will receive a 20% deduction on that business income as it flows over to your personal tax return where you're taxed only one time. The QBI deduction is a great benefit to S corporation owners, but it also extends to LLC owners and sole proprietors. So an additional benefit to eliminating part of that self-employment tax, you also get to receive this 20% qualified business income deduction. Strategy number 2, bonus depreciation. You might have heard of the word depreciation. I'm just gonna explain it for you if you're a business owner. Anytime that you're a business owner and you're purchasing equipment or you're purchasing items inside of your business that have a useful life of longer than a year as deemed by the IRS, you have to depreciate those items on your tax return over time. Let me give you an example. When you drive a car off a lot, you know that the car goes down in value. That's called depreciation. But when you're a business owner and you place vehicles and items in business purpose, you get to depreciate those items. Now, certain items, you may want to write them off all in 1 year. The IRS implemented the bonus depreciation rule, giving business owners the ability to write off items inside of their business all in 1 year. Bonus depreciation was introduced in 2002 through the Job Creation and Workers Assistance Act. Its purpose was to allow for more economic expansion and to allow for business owners to stimulate the economy by buying products and services from other individuals. In 2002, however, bonus depreciation was only 30% on whatever you spent on your items. So if you spent $100, you were only able to write off $30 in that particular year. In 2005, bonus depreciation was increased to 50%. And then in 2017, as a part of the Tax Cuts Jobs Act, Trump administration, he increased the bonus depreciation to 100%. So let's just say that you're a chiropractor or a doctor and you have furniture or desks, computers, adjustment tables. These items that you normally would have to write off over 3, 5, and 7 years, you're now able to write those items off all in 1 year, which means as a business owner, when you're thinking about making purchases to grow your business, you can now think in mind with the idea that you can write off something 100% as opposed to 50% or 30% in the past. This is helping out business owners because it's allowing them to reduce their taxes immediately, but also allowing them to grow their businesses. And at the same time, the government's winning because we're stimulating the economy every time we put dollars back out into the world. Let's go for tax strategy number 3, having a cash balance plan. Having a cash balance plan as a business owner is much more advantageous than just having a 401k because you can make way higher contributions to your own retirement accounts. This can be a real big lifesaver if you need to make sizable contributions to catch up for retirement planning. Just so you know, the retirement contributions for cash balance plans are based on age. However, when you contribute to your cash balance plan, it's going to reduce your taxable income. The cool part about the cash balance plan is you can set up a cash balance plan in addition to your 401k, maximizing your retirement savings through your S corporation. However, just make sure you're careful because you can expect a higher administrative cost for having these types of retirement accounts. You're typically going to have to pay a yearly ongoing fee to have these types of accounts. The contributions for an annual cash balance plan can be as high as $336,000.
What?
That's a lot of money going into a retirement plan. Strategy number 4, the Augusta rule. Part of the reason why I love the Augusta rule because it's a strategy where you get to utilize your house. If you are a homeowner and your house is not your primary place of business, then you can utilize the Augusta rule. The Augusta rule will allow for you to shift your business income to your personal income where you won't have a tax consequence. How it works is that you're able to rent out your house to your business for 14 days or less. So essentially your business is renting your house for 14 days and is not having to report any of the income as taxable income. This is giving business owners a deduction on a year-to-year basis because all you need to do is just make sure that you're conducting business meetings inside of your house in order to take this deduction. Let's talk about how we can have a business meeting inside of our house. So let's just say that we decided to host monthly masterminds inside of our house. And let's say our business we're real estate agents. If I'm a real estate agent and I'm hosting a monthly mastermind, I could be talking about the market, the interest rates that are currently going on, the pandemic, and how I can connect with clients better from a marketing perspective or from a sales perspective. But these monthly meetings that I'm having at my house, I'm gonna charge rent for these monthly meetings. And since I'm charging rent for these monthly meetings, my business gets to take a deduction based on me renting out my house for 14 days. The most important thing that we have to consider with the Augusta rule is our documentation and us taking reasonable rent fees. We can't just rent out our house for $15,000 and say that it costs $15,000 to rent out a suburban $650,000 house. It just won't fly. We need to make sure that we're taking reasonable amounts. And how we do this is by leveraging the internet. On the internet, you are able to go on the county assessor's websites to pull rents. You're able to go on Trulia, Zillow, Redfin. These apps will show you the rents in your area so you can take a reasonable amount based on the fair market values in your community or city or state. So it's so important that we take reasonable amounts, and it's important that we document it in the event of an audit. So if you're ever in an audit situation, you can show the IRS a printed out statement of the reasonable amounts that you took based on other areas in your community. And you will document your expense by tracking it in your QuickBooks or Excel program on how you do your bookkeeping. This tax law was created to protect residents of Augusta, Georgia, who would rent out their homes to people who were coming for the Masters Golf Tournament. Talk about a cool tax law. Before we move on, there are 2 rules with the Augusta that you have to remember. Number 1, you cannot use a rental property for the Augusta rule. It has to be a primary residence. It can't already be in business purpose. And number 2 is if you rent out your property for longer than the 14 days, which means 15 days and more, you have to report the income. The Augusta rule has a hard 14-day stop. We stop at 14 days. Last but not least is the management company. Part of the reason why I'm saying management company is because when you get to a place inside of your S corporation where you're making too much income, you're having a lot of money flowing over to you on a K-1 form and flowing over to you on a K-1 form where you're paying higher and higher taxes. And so we have to start looking at, well, does it make sense for us to switch out of the S-Corp to a C-Corporation, or would it make sense for us to possibly even leverage a management company? Now, you might be thinking, Carlton, how could a management company help me reduce taxes? That's just me creating another business. Well, think about it for a second. If you get to a place where you're making a lot of business income, maybe it would make sense for you to have another business that manages your business. And if you have another business that manages your business, wouldn't this other business have different responsibilities than your first business? Which means it could buy different equipment, which means it could have different expenses, which also means depending on how you set up that business can file a tax return on a different fiscal year end. So if I'm operating as an S corporation, making good money, let's just say $1-2 million net, I can pay a management fee to this off-year C corporation management company that does not file tax returns in the same year as my S corp, and now I've reduced my taxes on my S corp. Yes, this money has now went upstream to a new company, but now I have time to figure out how to offset that liability. And if I get to a place where I can't figure out enough expenses or strategies to reduce this taxable income in this new C corporation, well, at least the C corporation has a 21% federal tax rate maximum. So any net income that I have left over in my C corporation will be subject to a 21% federal tax rate, and the rest of it will be subject to state taxes based on if I'm in the state that taxes. Now, before thinking about setting up a management company, the most important thing is making sure you have a tax strategy. Any person that's just getting started in business should not just be setting up their own management companies just after watching one YouTube video. That is not tax planning. Tax planning is working with a tax strategist who is going to leverage the tax codes for you, figure out what all of your personal, business, real estate, and retirement goals are, so they're thinking about strategies they should be implementing now versus strategies they should be implementing in the future so they don't put you in a harmful position. Now, these 5 strategies probably are already piquing your interest, but there's one thing I want you to do. I want you to take advantage of this. Schedule a free consultation by visiting the link in my bio below so my team can help you determine if these 5 tax strategies are going to be useful for you, or maybe they'll be useful in the future. Either way, they're important for you to learn today. And also, if you don't mind, feel free to like, comment, subscribe. I'd love for you to do that. It's going to help me grow this YouTube channel so I can continue to make great content like this for you guys. I look forward to seeing you on the next one. Take care.